Yeah, Assalamu alaikum. Good morning. Can you hear us now?
Yes, we can, sir.
Yeah. Okay. Firstly, apologies for delaying this meeting we had on Thursday. Thursday, we had some technical issues, so we could not be able to complete it. So we had today for the same thing. I hope we are able to complete on time with no technical issues in. So we have actually, we are, my name is Mohammad Ajmal Basha. I'm the CEO of the company. Along with me joined our Mr. Abdullah Omar, who is the General Manager Corporate Affairs, Mohammad Saksi, who is the Legal Officer, Ahmed Kharusi, who is the General Manager for Distribution Transformers, Amin Sohami, who is General Manager Shared Service, Rajesh Khanna, who is Finance Controller. So we are having this meeting for investors primarily on the results of H1 2023. Go next. So this is a summary of the key indicators. We have done a sales of 12.92 million, and the raw material cost for this 12.92 million has been 8.32 million, which is 64.464%, which is something which is extraordinary in terms of how we performed from last year to this year. There is a gross profit of 2.65 million, which is 20.54% of the sales. We have made a profitability of 0.11 million, and though this is a 0.86% profit, but there's a turnaround in terms of what we have been doing to what we're doing now. We have also put the order of 17.71 million, which is also giving an indication of how we are progressing further. In terms of average operating capital, we are at 233 days, which is in line with what we have been doing previously. But there are plans to reduce this one to a drastic extent. So we have each key indicators. We are telling what was, how was it in Q1, Q2, and how was it performed with respect to last year. So the graph, what you see on the left side, is basically sales for Q1 and Q2. Q1 we had done a sales of 4.4 million, while Q2 we were able to increase it to 8.45 million. The primary reason being some of the order which were planned, specifically from African region, was not able to be converted in Q1. That was the reason there has been lower Q1 sales while compared to Q2. But we are trying to see that we are able to manage that in the same proportion as we go forward. When you go for H1 sales last year to current year, from 17 million, it is reduced to 12.9. Again, primarily this was due to some specific order which got delayed. In terms of sales distribution, we are managing our sales to with respect to domestic to export in the same way. Domestic is slightly higher this time with 52%, while export is 49%. This is also reduced because of the export order which we are not able to execute. Go next. Go next. In terms of raw material cost, you can see quarter one was 71.45%. There have been a big change in quarter two in terms of raw material cost. Raw material cost plays a key role in the overall performance of the company. Quarter two raw material cost has been at 60.72%. There are a few key reasons for that. I'll be discussing on those key reasons also in the end of the slide. But just to give you a feel of it, we have been doing some strategic orders, which has given the result of a lower MSR, and that again gives rise to multiple advantages what we can see. On the right side, you can see the raw material cost with respect to last year to current year. Last year it was 83%, has come down to 64%, which is almost 19%. This is the one which is a game changer here in terms of overall profitabilities. Go next. When it comes to other direct costs, the other direct costs in Q1 to Q2 has slightly increased from 837 to 1.1. Primarily, this increase is due to freight output which are there, which comes part of the export orders and all. And we have taken orders in export which are delivered to the place. So we have freight costs and all, which are contractual freight. That's the reason you have a slightly increase in freight costs. Same is reflecting in other direct costs also. While the direct costs which are primarily related to the overall operation remains as it is the same. The whole difference of 200,000, what you can see both in the quarter as well as in the year. Go next. In terms of export orders, this is again with respect to sales and administration cost. Sales and administration costs also increased from Q1 to Q2 primarily because of the sales what we had, and you can see there is a slight increase in last year to current year also. This is also because of export order where sales commissions and all it comes into picture. Again, there was CSR requirement was primarily included in Q2. That's the reason there is a slight increase. While in last year to current year, the increase is marginal, and that too based on the sales what we have. When you see the gross profit, there is a big jump in gross profit from Q1 to Q2. Q1 there was a gross profit of 440,000. Q2 we are able to manage 2.2 million, and you can see even in H1 last year compared to current year, there's almost more than 2 times increase from last year to this year. This is from
Somebody wants to enter.
Okay, from 1.12 million to 2.65 million, there's almost more than 2%, 2 times of the gross profit. This is also primarily the role which raw material cost control has played, which has given the gross profit increase. So next. When it comes to PAT, again, Q1, there was a negative PAT of 662,000, primarily because the sales were not even reaching the break-even point, while Q2, we were able to manage to 773,000, which is able to swap the profitability what we have. When you see the performance between last year to current year, H1, you can see against a 1.1 million loss of H1, we were able to manage a profitability of 111,000, which is almost 1.2 million change from compared to last year to this year. So next. When you see EBITDA also gives the same indicator. In terms of Q1 to Q2, there is a change in minus 366 to 1.298 million, which is a big jump as compared to Q1 Q2. The whole thing changed up in Q2. You can see the MSR previous slide, 60% coming up. That's what is the impact which you have here. Even as compared to last year to current year, against minus 488, we are at 932. We are over a million change in terms of EBITDA also as compared to last year to this year. So next. So now if you see what are the key contributors for the result, there are some positive contributors, there are some negative contributors. Positive contributors are large repair service order, which has given large margin. Service orders are something which has got a bigger margin rate in double digits. These are some of the things which is a focus area what we have. And this is what we are able to see in Q2 performance and half-yearly performance, which has given a higher profitability. We are also monitoring raw material in a very, very close manner as we had committed last time. And this is one of the prime reason the raw material cost has been under control. Raw material cost is being monitored on a very regular basis in terms of your copper, your CRGO, steel and all. This is one of the reasons the positive contribution has come. Oil and gas orders and new market entered are also with high margins. We are executing orders with oil and gas which are with margins which are considerably good. And this is the strategy what we had in place where we are going to have a mix of products which can give you better margin. Positive cash flow is there, thereby we are able to reduce the finance cost, and that's how we are able to manage our cash flow as well as finance cost, reducing the cost so that we can have increase in bottom line. Project of switchgear division, revamp and transformer division, lean project, this is going as per plan. Whatever we planned for the revamp in the projects, the switchgear revamp has been done to extent of the manpower, whatever was done. And in terms of transformer division, lean project is also going on plan. This will also start reaping the fruits. So these are going to give us fruits as we go forward.
Ajman, we will just do something related to admitting. There are some people who want to join. Sorry for that. So we can admit on. Go back to the presentation.
Okay, so I think there are people who are joining, so we're just pausing and just coming back. So I was talking about commodity price. Commodity price is something which is also in favor of our vision towards the profitability. Commodity prices are by and large in a very, I cannot say stable manner, but not in a fashion it used to be previously. So there is a commodity prices which are ranging in 10 to 12% of variance, and we are able to manage that variance. And we are able to, since we are planning the raw material very closely, we are able to ensure that we don't have risk because of commodity price issues. There are a few negative contributors, a few orders from African project. We had project from Libya and Nigeria. This project has got delayed because of political and financial reason. Like in Q1, we had project to be executed for Nigeria. Nigeria elections, or presidential elections and all delayed drastically. Their currency problem was there. They were not able to get the dollars and all. This further delayed the whole project, resulting into a Q1 delay for us. And that's what some of the negative contributors for us. This has even affected our sales as well as the order booking.
Just 1 second. Yes. Yeah.
Yes.
Okay, there are some changes in regulation in some of the market for customs and preference, like Saudi Arabia has got custom duty of almost 15%, and preferential treatment in Kuwait is there. These are also some of the regulation which has some negative contribution in terms of our strategy going forward, what we plan for and what we want to do. There may be slight tweaking in the strategy to ensure that these changes are not impacted to us and we are able to align ourselves with that. There is Chinese expansion into the market. In Oman specifically, Chinese were considerably not visible, but Chinese expansion has come into the market. That is one which we need to work out how we deal with it. And including that with respect to IPP projects, which are largely price driven, because here the accruals, things are not there. These are projects which are primarily done by developers. These projects are price driven, and this is something which we need to align ourselves, because in the current time, in the electrical sector, in the energy sector primarily, the development is primarily on the IPP side, where a lot of renewable energy is coming in. And this is something which we are working on to see that this doesn't affect our overall growth and our strategy. So we are working on this direction, which is current time in terms of order. We have this as a negative contributor. Oil and gas project in Kuwait are going slow and delayed. There were a lot of oil and gas projects done by some of our customers. This has been slowed down primarily because of various supply chain issues coming up from Europe and all. And this has also delayed our deliveries and our commitments to the customer. So these are the major positive and negative contributors which are contributed to the result. So next. In terms of learning action going forward, the investor who has attended the meeting last time, this was some of the key things we were identified. We identified to see that we are able to work on those and correct it so that we are not having the same situation what we had in 2022 and 21. If you see risk assessment, we have made a framework done, and this is a process which is an ongoing process to ensure that we don't get into a problem of high risk and commit something which is going to create problem for us. So this framework has been done and the process is ongoing. Regular monitoring action on commodity prices. This is an ongoing activity for us. We have a weekly session on that. We have a monthly session on that. There's a different type of mechanism where we know what's going to happen today and tomorrow, so that we are able to act on it. Enhancing product portfolio. We have been doing all this strategy for 7 products in place. We already worked on. We have made an MOU for 4 products actually, and these 4 products we are trying to work out how we are able to manage those expectations in terms of making agreement and launching the product. And this is in place. This has been identified as part of our strategy. Enhancing the productivity, as I said, the VTO, the distribution transfer plant is working on the lean project, which is underway. We already started the civil construction for that. And this is going to bring about a change in terms of how we look towards the market in terms of distribution transformer and our productivity and efficiency. Strategy to remove low or loss-making product. This is also implemented. Like Voltime Energy revamp was one of a project focused on this particular action, where low voltage switchgear was an item which was actually giving us a lot of loss, primarily because we were working at more than 90% raw material cost into that, and we are not making profitability. So we are done with these products. I can say that we have reduced this product in a phased manner, so that whatever experience we gain, we don't just leave it off, but we reduce it and only focus on strategic high value projects. Otherwise, we don't focus on that. Similarly, feeder pillars were there. These are the products which are low value and high MSR product. We are done away with this product also. So this is also part of our strategy which is implemented. Frequent monitoring of project and ensuring short closure of the same. This was also the learning which we had from Karama project and CP project. So we are taking our orders in line with this requirement, which is ongoing way, where we are not committing on the large projects which are going for 4 or 5 years, so that we risk it. If you're going to have such kind of project, we are taking our own risk mitigation plan into that. Detailed plan on transformation of business. This is slightly delayed because we were looking for having someone to dedicatedly focus on that. This digitization project is slightly delayed, but this has nothing to do in terms of our business strategy planning and all. Expanding the market base to more vibrant and low-risk countries is ongoing. Focus is redone in terms of looking into GCC market, the Europe market, and US market. We are likely to enter into this market in very quick succession. GCC market, we are already approved with multiple utilities. We have been approved with ADNOC, Transco, DIVA, and all. These are some of the key customers, and this will open market in terms of GCC, which is low risk when we see as compared to we go to Africa or other countries which are non-committing on any long-term contract. This is what I have said already previous one. This is in place. Non-exclusivity with any partner to hold delay in market expansion. This also, we already started changing our agreements with our agents, where we are going for non-exclusivity. Actually, this will give us a lot of flexibility in terms of changing our strategy, aligning ourselves, and using multiple agents. This is also part in place. We already done for a few of our agents. In-country value need alignment. This is something which is very important in terms of sustaining Oman business. We are, as a company, we are pushing to various decision makers in Ministry of Energy, Minister of Commerce, Madan, Nama Group, ICVs, and all these people. And we hope we'll be able to put this in place. Even now, recently, Nama has announced for ICVs for the local manufacturer. This is something which is going in a nice manner. We hope we'll be able to leverage from this in-country value. So these are the key learnings what we identified last year, and these are the actions which we are going on. And that's what we have for the presentation. Now I'll open it for question and answers, or if there is any specific thing in terms of presentation or anything else also. Open the screen.
Hello.
Yeah.
Hi. Good morning. Thank you for the presentation. This is Bishan Bhalla from Vision Capital. You know, you mentioned that raw material cost was a key driver of profitability. Higher revenue and lower raw material cost was the key driver for profitability during Q2. Can you hear me? Hello?
Yeah, we can hear you. Continue.
Yeah, sure. Okay. So whilst we understand the reasons for sort of the lower revenue in Q1, you mentioned the delay in African projects, and this is more of a normalized revenue in Q2. Raw material cost, if I see historically, you know, it's been approximately 75 to 80% of your overall revenue. And whilst, you know, 60 is a great number, what is a more sustainable number for raw material cost, or is this the sort of new norm going ahead, given the way you've shaped up your business based on what all you've learned from last year? That's the first question.
So I answer it this way, Vishen. Thanks for asking this question. Primarily, as I said, in Q2, 60% is something which is not a normal level of raw material cost. The normal level of raw material cost ranges from 67 to 73%. This is the band what is there for different types of transformers. 60 primarily we were able to manage in Q2. The reason being that we were able to back some critical service orders. Service orders comes with a lower MSRs, where you do more of activity and less of raw material consumption. Okay, that reason Q2 is special. I can say it very clearly that 60 cannot be the benchmark, and it is not a benchmark. It's not a new normal. But going forward, around 67 to 73% is the normal which is there in this type of industry.
Yeah, I think that's also a good number to look at. If I see historically, yes, you have been around the 72, 73% mark in some of the years, but even 67 to 73 would be a decent number, because your Q1 number again was 72%. Now, I remember, you know, during one of our interactions, you had mentioned that one of the key risks where it comes to a full project, not a service activity like you did in Q2, but for, let's say, a full project implementation where you bid for a project, the key risk is between bidding for the project and being awarded the project, the raw material variation, because that is something you can't hedge because you've not won the contract. And if that moves against you, that is something that could impact the margins. Is that understanding correct?
Absolutely.
Okay. So now all you're sort of hoping for, all you're seeing is that there is a stability in raw material prices. They're not too erratic. So given that, this 67 to 73% margin or sort of raw material cost is the norm in a normal market where commodity prices don't move too extremely, correct?
Absolutely. Primarily, what we see is there is a market trend, or generally the way the market works for our type of product is that the project time for completion is from the day the tender is released, from the tender is opened, and the order is given, is around 6 to 9 months. Okay, this is the time period based on what is the type of contract what type of product we are looking at. And this 6 to 9 months is a normal period. While when we see the commodity prices hovering around 10 to 12% plus minus is also a market situation. Okay, so what we do when we do for tendering is, with this type of fluctuations and this type of timeline, we actually pitch ourselves for the price. But unlike previous years in 2020, 21 and all, what we saw was this was completely erratic. Even the raw material price was going around 40 to 50% up and down. And the project time also post-COVID and even in the COVID period, time for completion and the time for awarding the order used to be 12 to 14 months. So that too played negative to the whole aspect of it.
Noted. Now, I think if I'm not mistaken, you mentioned your order book. I missed the first slide. Was it around 17 million?
17 million is what we booked in first half of the year.
And what's your current pending order book?
Pending order book at the group level is 19.5 million.
Right. Now, you do on average, if I see the last 3 years, you're around the 32, 33 million real mark annual sort of revenue.
Yeah.
And I understand that it's a mix of locked in contracts with incremental contracts that you pick up on the way as well as service. So currently we're looking at almost half of your business coming from a locked in order book. What would be the incremental order book or incremental contracts that the company would target on an annual basis?
What we do primarily is we have targeted around 35 to 40 million. That's the range what we have targeted ourselves to book the order for this year, which is in the worst case and the best case scenario, because there are some projects which are large projects. Sometimes it goes off the radar in terms of customer violation and all. That's just the band is like that. So we are able to do 17. We are hopeful that by this year end, we will be able to achieve our target between that band of 35 to 40 million.
Okay. Okay. No, excellent. In fact, I was going to come to that. I didn't want to ask you directly, but now that you've outlined it, that's great. In terms of, I understand Q1, Q2 had their own challenges and positives. But let's say on a normalized basis, if the company were to implement a 35 to 40 million sort of top line, what would be a ballpark? Again, I'm not putting you to a number, but what would be a ballpark sort of flow through net margin, given all that you know and given the way you've shaped up your business now? For sort of the long term, for the medium term, what would be a sustainable margin on a net basis for the company?
If you see, that will be too different to answer, but I'll tell you one thing. The way we are seeing now in terms of our approach to a market with what has been done previously and all, we are looking to have a sustainable sales and profitability. Okay, and we are not picking up orders which are going to have a risk for us. We are not executing orders which are going to have issues with respect to collection of the money or unable to deliver and all, because that's how we are looking into it. I have orders which are like around 5 million, which I can manufacture it, but I'm not manufacturing considering the risk which is there in place. So considering all the scenario, our first target is to see that it's not the top line, it's the bottom line, which is the most important one. And it changes drastically based on how the top line works together. So we are looking for a considerable and nice profitability in terms of looking into the year end for this year, for sure. I may not be able to exactly pinpoint how much will the profit range and all.
Okay, sure, that's fine. You know what? There are others also who raised their hand, so I'll go back in line and I can ask my questions later.
Yeah.
That's it for now. I'll come back later. Thank you so much.
Thanks.
Good morning, gentlemen. This is Abbas Muslimi. I work as a portfolio manager with Vision Capital. I'm also Bishan's colleague. Thank you for the call. Thank you for the presentation. I was reflecting on the statement that you said that your raw material cost as a percentage of sales on average is between 67 to 72%. Now, when I look at this quarter, you've ended up with a 770,000 real net profit, a 9% margin. At the same time, your raw material cost was 60%. Now, there is obviously some sort of a one-off nature in that. You've also indicated that things should revert to the average raw material cost. If I take that into account, and the moment I kind of go up to your 70% average that I've seen for the last 4 or 5 years, then effectively you would have been neutral on a bottom line basis. You would not have ended up with a profit, not a loss, but you would have been zero. And the same thing if I reflect, the last time you were making profitability, healthy profitability, what I mean is around 3 million plus was in 17. Since that, even pre-COVID 18, 19, the company had a challenging time. You managed to make some money, but it's not enough to sort of compensate shareholders in the form of a dividend or, some sort of a return on capital. So from that perspective, when I look at the first half and the moment I take out this one-off nature of the second quarter, it looks like the company is definitely on the right path. But the path to this profitability of 7-8% net margin is still a long way ahead of us, right? I mean, any comments on this? Because I'm just reflecting the raw material cost and just keeping everything other than that as a fixed cost structure. And that what tells me that even the second quarter profitability is sort of a one-off.
Yeah, thanks, Abbas, for the question. You are actually right on that part because the profitability is a factor of your sales, your raw material cost, and the expenses what you have, and the profitability what we have. So if you consider that way, there is a break-even point for the sales. There is with respect to 67 to 73% of the MSR. It's 67 to 73. That is the range what we have. And when you work on average of 70, unless and until you make a profitable, you make a sales value of beyond 30 to 33 million, you are at that BEP point. Okay. So here what we do is when you go back to 2017 or 16 profitability of 3 million and all, those are a different scenarios. Both in those periods, primarily the markets were different, the competition levels were different, and the price structures were different actually. Okay, and Voltamp used to do almost 70% of domestic and 30% of exports, and the total value composition was different, and the challenges were different. Now, for us as a company to reach to that level of 6 to 7 or 8% of profitability, there are different strategies in place. Okay, so with the current way, what we are changing from what we have been doing to what we have done in last 3 years to what we are going to do from this year onwards are a bit different. We have multiple things in place which are there in terms of our strategy, which is short term as well as long term strategy, because the change which is going to happen immediately is not what you can see for that type of net margins. We are seeing a net margins going to 3.5 to 4% to going to 6% to 7% to 8% in period of maybe next 5 6 years. You're surely going to see that type of profitability, but the sales will also be different. Sales levels will be different, sales composition will be different, market will be different, product will be different. Like when I'm talking about 7 new products, each products are revenue generators. Those are the lead indicators for us where we generate the revenue as well as profitability in a different manner. So we have those strategies in place. So if you, to answer you in a straight manner, if you're looking to 2016-17 of profitability to be coming up now, I don't think that's going to happen very quickly because it is not a sustainable one, and that's the reason it has collapsed. And since it is
Correct.
not a sustainable one, we need to have something which are sustainable. In sustainability, you need to have various different products, various different markets, so that your dependency is lower.
Thank you. Thank you for that very clear sort of answer, which also covers all different perspectives of how do we look at your business. So now when I consider your current sort of year and what you've been achieving for the last couple of years, there are some things that you can do at your level. At the end of the day, you are slaves to the raw material prices. At the end of the day, it's a commodities business or driven business largely. So from that perspective, can I ask you in terms of what sort of utilization levels are you working at in your power and distribution transformer business, and what sort of order book or what sort of market growth are you seeing? What sort of market demand are you seeing over the next 12 to 24 months in both in the local and the domestic and the export markets? Just some flavor of the market, sir.
Yeah, so if you see in terms of our utilization, actually, as I said previously also, our current strategy for 2023 is primarily to be profitable. We are not looking into just bagging orders because we can bag orders because orders are available actually. By the way, just to answer it, as compared to last 3 years, the current year, the orders levels are high, the market is having requirements, and it's up to who is able to, which company which is able to take what they want to take. So currently, as far as distribution transfer company is concerned, we are almost loaded up to 80% of our capacities. Power transfer is loaded up to 65% of the capacity because we have not taken some of the export orders which we wanted to take, and that's the reason, that's the advantage what we have in terms of capacity building. And going forward, when we see Oman OETC, which has currently released almost 7 tenders, which is almost valuing around 15 to 18 million of products, what we do in terms of power and distribution transformers. These are going to get finalized in coming months to come. This is some which is a good indicator in terms of Oman requirement. The Oman business is also picking up in a good manner, and we see that in next 2 to 3 years, Oman business will be becoming normalized in terms of what it used to be. When it goes to market in GCC, Saudi Arabia is the largest market. Saudi Arabia market is almost 10 times of Oman market. It is half of the GCC market, and we are talking in trillions there. And we have put our strategy in place for Saudi Arabia. Like big projects like NEOM and all are there. We are Voltam was able to have orders with NEOM. NEOM, you may be knowing, NEOM is the largest, currently the largest project being done in the world, which is in the north western part of Saudi Arabia, where there are three large projects. One is the line, which is a 172 kilometers single line of 500 meters height. Then there is a Oxagon, which is an industrial estate, and Trojan, which is a destination for entertainment. So these three projects combined together, the budget for 2030 is something which is unimaginably high, and we are actually into it. Like even last week, we had delegates from NEOM and all. So Saudi Arabia is a large market. Saudi Arabia is going in a very, very big manner, and we are aligning ourselves towards that. UAE is also in a position which it has been sustainably doing what it was doing, but we cannot consider that as a growth market. But it's a sustained market, which is it's a standard market. What we see, Qatar is not same as what used to be for after before FIFA. Now it is in a very lower level. Bahrain is a small market, and there are markets like Iraq, Kuwait, and markets in the lower part of Caucasus, which are developing very fast. These are the market which we are trying to look into. But we see that US and Europe is also a market which is very, very changing market, where the old technologies are being revamped to the new technology. That's the reason we are focusing into that market as well. So what we see as Voltam, we are having a very, very cautious way of approaching towards each market, so that we don't bring something new for our own risk appetite. So we are watchful. We are seeing that a growth of 10 to 15% every year in terms of sales growth is what we are expecting.
Okay, thank you. Just the last comment on Saudi Arabia, when I talk to other Omani industrial companies on the ceramic side, steel side, I mean, they are facing this big challenge with import duties where they're not able to compete with, Saudi players or other larger players because of this import duty. Even though we are part of this GCC common area, it seems, this import duty is not being waived off, and that's been, happening across industries. Isn't that a challenge for you? I mean, I understand the Saudi opportunity, we've been reading about it, we've been talking about it. But in reality, when you actually look at the market, are you able to compete despite this duty?
If you see, there is something called LCGPA. This is Local Content Government Procurement Authority. This is a ministry level authority which has been put in place in Saudi Arabia, which is actually supporting and enhancing the local content of the manufacturer there. So you need to see in that perspective, first of all. The second thing is there is a custom duty which is in place between 15 to 25% in Saudi Arabia, and there are some ways and means in terms of how we approach to that, because there is a guidelines which says that if you are able to localize, like I'm just sharing the way we see it. If you're a local company in GCC, if you have a harmonization of say 40%, more than 25% is a mandate. If you have a localization more than 25%, if your local content value addition which you're doing in your country in GCC is more than 40%, if you're able to get a country of origin of Oman, then if you're able to give these requirements to the custom authority, you can get custom waiver. Okay, so if you have a company which is doing trading, they cannot compete. If a company which is just assembling, they cannot compete. A company which is in today's time, I'm just telling in today's time because situation change very frequently. In today's time, we are working towards that direction. And like when we are supplying project to Sudair in Saudi Arabia, we were able to provide this documentation for custom exemption, and this is part of the rule. So if any company is able to manage this requirement, they should be able to fight with the in the market.
And you actually managed to get the exemption?
Yes, For our project of
Wow. Okay, that is
10.5
news to me
megawatts,
because no other companies in Oman that I've been talking to, at least on the listed side, have been successful in getting this.
yeah,
So
yeah.
congratulations to you guys.
Yeah.
If you managed to
So,
do that, that's fantastic
so this
from your
is
side.
project wise. This is project wise. Like for Sudev project, we were executing for a large project. It's almost 16.5 million US dollar. And this whole project, we were able to provide all the documentation and all, and we were able to do it. Actually, we were asking similar rules comes in Oman also. It will be helpful.
Right, makes sense. I mean, I know some companies talk about that on the cement side, where there's a lot of supply from the GCC, dumping in the market. But very interesting point. My final question is, Oman obviously is a very important market to you. Historically, when you were making the 3.5 million profitability, it was 70% of your sales. Now it's 50%. You spoke about competitive pressures in Oman. Now I know there's another player called Al Jizi Transformer, who's based in Oman. Is there any other transformer setup that's coming up, or from like a greenfield perspective?
If you see, we have three products: power transformer, distribution transformer, switchgear. Power transformer, we don't have competition from within in Oman. Primarily, the competition comes from Europe and Far East, and we were able to manage that expectation. But now with Chinese coming into this market, it's a bit tougher situation for us. While it comes to distribution transformer, apart from this, Algizi is a distribution transformer manufacturer. Apart from Algizi, there is a Federal Transformer and Oman Transformer. These are the other three companies which are there, which are competitors for Voltam. And despite of these four companies in Oman, Voltam still have the credibility in terms of supplies and records, and we have a bigger market share as well. But when it comes to switchgear, actually, switchgear business is they are like 11 established manufacturers in switchgear. That's reason we are not able to compete with their level of competition, because there in those companies, those are small companies where the focus on localization is less, the focus on overall business working are different. So we are not able to compete in that type of environment. That's the reason we're trying to switch off from products which are low technology, low value product to high technology, high value product.
Understood. Thank you. Thank you very much for your answers, and
Thanks.
all the very best to you. Look forward to talking to
Thanks.
you soon. Thank you.
Thanks a lot. Thanks.
Jassim. No more.
Mr. Jasif.
Yeah, Assalamu alaikum, Mr. Ajmal.
Walaikum salam wa rahmatullah.
Good morning. How are you, everybody?
Alhamdulillah.
I joined just probably half an hour back. I don't know. I think I've seen some Omanis with you. Have you introduced them to in the meeting? Because it is very pleasure for us to see Omanis in the meetings.
Yeah, actually, you
We
joined
have
a bit late. So if you see Voltam as a company, we are 42% Omanized. Okay, we are Omanized at every level. I have introduced my team. I'll introduce again for yourself. Mr. Abdullah Umar is there, who is the General Manager of Corporate Affairs. Mr. Abdullah Umar has been there in the organization for quite some time. We have Mohammad Saksi, who's our legal officer. He has been working on corporate and legal part. Amin Suhomi is there. He's our General Manager Shared Service. He takes care of complete activities on that. Ahmed Kharusi is our General Manager for Distribution Transform Business. And then you have Khaled and Rajesh Khanna, who is the Finance Controller. Myself, Mohammad Ajmal Basha, I'm the CEO of the company. So we have a mix of people which are there.
wish you the best.
Thanks.
Just as we are small investors and small what we call this shareholders. Probably in the last annual meetings, probably the only Omani always there in the meetings. Mr. Ajmal, I believe you have been in the company just probably a few years back, and you have shifted from leadership from all this what you call it, the subsidiaries company. It seems to be that you are in the right seat to take this company to the better future, inshallah.
Inshallah, inshallah.
Inshallah. This is a very difficult market, industry market. Always, this sector is always, tough to lead. Or whatever to be better. I wanted to ask about, your main this revenue. Which company the most? It's the major. What you call it? Major revenue you have from it. The transformers business, or the other one, the power.
Thanks, Mr. Jassi. I'll just give you something about myself also, so that it gives a perspective to you. I joined 4.5 years back in Voltam. I joined as general manager for Voltam, and from general manager of Voltam Power, which is then Sohar, I came to distribution transformer. I was taking care of distribution transfer power. Then I became the CEO, then the CEO now. Before joining Voltam, I was in Saudi Arabia. I established a distribution transfer company in Saudi Arabia from scratch, and I was heading distribution transfer switchgear business in Saudi Arabia for 11 years. So I have, by and large, more than 15 years in GCC. So I know everyone how it works and how the market works. And post that, we have within the team what we have, the I can say new, renewed with old experienced team what we have. We have people like Ahmed Kharuzi, who has joined from experience from PDO and all, who heads the distribution transfer business. I have Abdullah Wahebi, who is the general manager for switchgear business, who also comes from market background and all. And I have one more guy called Anirban, who is the general manager for power transfer. So the whole key here is the type of team, the type of people who are in terms of knowing the product and market is what is most important. So that's how we try to align ourselves so that we are able to get into it. In terms of market, if you see, we are 50%, almost 50%, we are doing business in Oman, 50% business outside Oman. So this outside Oman business has been shifting a bit as based on the market scenarios. We have been supplying last to Qatar. We have been supplying a lot to Kuwait. Now we are supplying a lot to Saudi Arabia. Okay, so in last 5 years, I can see the moment when Voltam started focusing on the export business. Export business has been between Qatar, Kuwait, and Saudi Arabia. So every year we have been doing a lot of business, almost 10 to 12 million of business in any one of this country. Like Qatar, consistently we have been doing around 7 million for last 3.5 years. Kuwait, we had done almost 30 million business in last 4 years. Saudi Arabia has picked up from last year, and this year and last year we have done almost 11 million business. So that's how we look for. Apart from GCC, we are also having business in 19 other countries as we speak today. We have been supplying to Nigeria. We have big order from Nigeria. Iraq is there, Gabon is there, Gambia is there, Kenya is there, Tanzania is there. These countries also we supply a good amount of repeated customers. But seeing the way the political and financial situation are, we see that African market is a bit risky market for us, specifically some of the market. And that's the reason we want to align ourselves in terms of GCC, Europe, and US. So we have got one order which we are executing for Lithuania and Europe, and we are expecting one more order to come from Europe and from US. So these are the markets which are our strategic markets where we are able to supply export, we are able to get our revenue bottom line, as well as we secure our money.
And to Mr. Jassim, as you asked, so our major revenue comes from a transformer business, and the lower revenue from switchgear business.
Okay, so I did not answer that.
Yeah.
Okay, we have, as I said, we have power transfer, distribution transfer, and switchgear. Power transfer, distribution transfer contributes almost 40 to 45% each, and switchgear contributes around 5 to 10% only as far as our company total revenue is concerned.
Thank you, Ajmal, for your answers. I have small other two questions, probably in a quick way. Because you are in Saudi Arabia. Saudi Arabia is a big market, and you are having a good now probably better business with them. I believe. I mean, even looking to the previous years, for the last 5 years, my colleagues have spoken about in 2017 when you have a good margin around 3 million probably as a profit because of also the turnover. As from your slide, it was showing 41 your revenue compared to, I mean, was I think in 2019, I believe, and the problems with your probably not doing good for the previous 3 years. It was the raw material, as you said, but since then, from last year, you said the raw material it has been balanced, and your quarter, your result, the first quarter second quarter compared to first quarter is really promising. Are you going? You feel? I mean, since you are in this market, the next 2 quarters and the next year, how do you see your company? I mean, profitability or competent with other what you call market, and especially the GCC?
So if you see, we are hopeful, inshallah, Q3 and Q4 also be positive only. That's what is our target. And going forward, we want to be a profitable company, a sustainable, profitable company. We don't want to go back into what has happened previously, but we want to see going forward what we do change. There has been a lot of changes in terms of how we approach the product and market. Like we already developed 3 new products which are there in the market. Like when I was previously speaking about OETC tender, the project which has come from OETC tender of almost 10 million is related to the products which we have done in the last couple of years. Seeing that, we see that going forward we have a positive vision.
Last question, probably, Mr. Ajmal. Regarding staff, from your what you call it, the MSM website, I've seen staff 192 plus 366. Are they are these numbers are correct, or you have different by the end of the year 2022? And did you have, some new staff has joined? Probably the old staff you have probably let them go. Can you give me some figures about the staff and the year end 22? And is there any new graduate people has joined you? 5 people or I knew this is staff is always or recruitment is very difficult situation always, you know.
So if you see, actually that figure needs some correction, because that needs some correction. We saw that one and we want to correct that. We have actually 256 expatriates now. There has been a lot of reduction in expatriate, primarily post our Volta energy revamp and all. And in terms of Omanis, we are 189 right now. And we have been on a continuous basis, Ahmed, if you can add, on a continuous basis, we have been investing on our new employees. Ahmed, if you want to add something on how you're programming in terms of...
Yes, for example, on Volta transformers, Oman, we reached 47.4% Omanization, and we are going into training and development program for newcomers. And we continuously take people on training, paid training. We pay them and they train with us for 6 months, and then we select people. It's like our mechanism of selection of better and good talent of Omanis to include them in our workforce.
So if you see, just to add, in 2023 strategy also, we had for all our units, we had mandated that we will have 5 Omani development program. This is like we take 5 fresh Omanis, we develop those Omanis and bring them to the ladder. This is how we generally in the MNCs and all, we work in a way we get graduate trainees and all. We work on them, we train them, we educate them, we work on them so that they are able to take the roles as it goes forward. So we are working on those also, and we are able to achieve, like we know internally ourselves who are our futures.
And in terms of talent and certain positions, we can claim confidently that in terms of transformer manufacture in the whole region or the whole GCC, that we have positions filled with Omanis, and you will not find these positions filled with locals in any of the transformer manufacturer in the GCC. We went down even to winders. We have Omani winders. We developed them, and this is the first time in the GCC. We have designers. We have Omani designers. They are developing and designing the transformers. And we have them all over. We have ladies even. We have women in production. We have supervisors like Wiam Dohani. She is a supervisor in production in the shop floor. So yeah, we are very ambitious with our Omanization, and again, the key is selection.
Sure. Thank you, Ajmal. It was I am very pleased to hear this from you and Ahmed also. And next time, inshallah, your next discussion, I think we hope that to see some young Omanis joining this discussion, and we can talk in Arabic, because it will be also good for them to know what is the company and what they're doing. Inshallah. Wish you all the best. Inshallah.
Thanks a lot. Inshallah.
Thank you.
Somebody also wanted to ask something.
Someone want to ask?
في الكيو ما في حد.
Mr. Matthew?
Okay.
Good morning, gentlemen. Thank you for the presentation and answering these questions very patiently. And I have some few follow-up questions on this. One is about in the second quarter, you said you had a large repair order. So can you throw some light as to the status of this? Is it still under execution, or is it was it over during the second quarter itself?
If you see, this is the order. Actually, we were working with Saudi Aramco for quite some time, because Saudi Aramco is a large utility, if you are aware of, in Saudi Arabia. And Saudi Aramco was very in a situation where they were not able to maintain the transformers and all. So we were able to bring them, had a lot of discussion, commitments and all. We were able to bag an order from them, and that order had executed in Q2. So it's already executed. The project was primarily to get the transformer, get it repaired, and deliver to them. This is a large transformer. This is like I can say a big elephant of 230 tons.
And I would like to add something here. So actually, Aramco approached us after we published the news that we have manufactured the 500 MVA 400 kV transformer. This is the largest in the whole Middle East. We made Oman country number 31 in the whole world in terms of the capacity to manufacture. So we have also embarked in a new PR marketing strategy. And when we posted this, it came to the attention of Aramco, and then they approached us. That they started asking, "You have this capacity?" We said yes. They came, they visited, they verified, and then the order came.
Okay, thank you very much. The next is on the status of your Karama project. Are the deliveries over and all the financials closed? Are there any further losses expected from this?
Karama, actually, we had this project in 2017, and it is one of the reason of our bleeding during 2019-20 and all. We were successfully able to close this project, foreclose, I can say, in September 2022. We had to take back some of the transformers, which was part of the project from them, which is there in our inventory right now, which we are planning to sell. But otherwise, as far as Karama is concerned, we closed the contract, and we are out of any liability what we had with that contract now.
So if we are selling these transformers, how will we account it? Are they accounted as the cost already, or are we still keeping them as inventory at cost?
Can you explain, Rajesh?
So right now these are in our inventory. So that cost of sales will get adjusted with the revenue when we sell it.
Okay, got it. Thank you.
Just for your update, this has been affected in 2022 itself. So 2022, we got back this transformer and taken back as our inventory. So whatever impact was already taken care of.
Yeah, correct.
Got it, sir. And also, can you throw some light on your Sohar plant, like the details of its features, the capacity, the current utilization? You said it's around 60-65%. And the order book and maybe the order pipeline that we should be expecting for on the roadmap that we should have for this plant. Also, if we can share some financial aspects such as the break-even level and what's the current status, all these things would be very helpful.
Voltam Power is the largest company in GCC region. The ratings what it manufacture, that's the company which has made the 400 kV transformer. There is no one in GCC and MENA region to manufacture a 400 kV transformer. Voltam Power is considered within the GCC as a key manufacturer for power transformer in the region, because large power transformers generally come from Europe and Far East. And with the current scenario of supply chain issues and all, Voltam Power has got a big potential in terms of expanding its business. And the service job what we have done is also from Voltam Power, because this transformer has come from Saudi Aramco to Sohar facility. As I said, Sohar facility is having an installed capacity of 7,000 MVA. We call in terms of MVA when we talk about capacity. In terms of revenue, if I convert, because it depends in a different manner. If it is large transformer, the revenues and MVAs are different. Small transformer revenues and MVAs are different. So we manufacture around 125 to 150 transformers or 7,000 MVA, or in terms of revenue, around 22 to 25 million of sales can come within the company, what is there right now. So this is how the company is, and it has approval from just enter. It has got approval from almost all utilities now with 10 years supply, because the product what is supplied from Sohar is primarily a capital item. It's a large item. There was some question.
No.
I'll just answer you, Mr. Yaqub, once I'm completing this answer. So, full-time power is approved with many of the utilities and all. And since this is a capital item, it is very important that the experience are there and titles are there, which we are able to already get now. So, we have a bright future. Full-time power has a bright future. And I think within the group, it has products which can take it far into different places. Even United States, what we're looking for is primarily for this type of product only. To answer Mr. Yaqub, we are Voltam is already in positive income. Q2 we have already made positive. As of H1 we are positive, and inshallah we are hoping that going forward we will be positive only for Q3 and Q4. That's what is our target. So we are already positive, just to confirm you, and we are inshallah going to be positive further also.
Okay. Can you talk about the IPP sector? Because the focus is right now on renewables, and there's a paradigm shift that's happening. And you, in your presentation, you said it's not contributing anything positively right now. So can you share some dynamics of this market, and how are you planning to address the needs of this market? Will it be requiring any further new investments or significant investments from Voltam, or minor design changes at the plant would be sufficient? Also, can you please touch upon the competition, how the demand is met currently, because right now we have new IPPs coming in.
The IPPs is a Pandula box, to be in a lighter side. IPPs are currently not properly regulated. IPPs are in currently, you know it, as you said, and I have said it in the beginning also. In the whole sector, energy sector, the major investment, the major energy generation is coming from IPPs, whether it is through renewable energy or hydrogen or whatever you call it. And IPPs are primarily in the current time are developer based. Okay, and Chinese are very, very aggressive into this market, and they come with their investment and their products. Okay, and to combat that requirement, countries like Saudi Arabia and all have put this local content in place, where the development will also happen, investment will also happen, and that's how the whole scenario. In Oman also, we are working with the ICV teams in OIA as well as NAMA to make aware of this scenario, where if China as a developer comes in for an IPP project, invests into the IPP project and brings the product from China, then practically you're not doing any development within the country, and that's a different scenario. And that's how we are working it. But to just answer you in terms of our engagement and involvement, we are like we are into multiple IPP projects in Saudi Arabia. We already supplied in many IPP projects in Saudi Arabia, whether it is PIF 1 or 2 or 3 or NEOM, we are into that. And in UAE also, we are working with Masdar. We are not able to have a breakthrough with Masdar, but we are hopeful that we should be able to have a breakthrough. Here in Oman, we have this Mana 1, Mana 2, which is primarily here now. We are both are going with some Chinese manufacturer. We are working with the OPWP, with the OIA and all, to make them understand and get the alignment of what is their vision and all towards these IPP projects. So the IPPs are challenging. IPPs are driven through developers. So we are also making our strategy, and maybe if everything goes well, we may also become a developer.
So are we currently going through a trading strategy where you procure it from the Chinese supplier and then supply to NAMA?
You see, we are not a trader. We are manufacturer. We manufacture. For us, all these Chinese manufacturer or any European manufacturer are our competitors. we are talking about, we develop products which are going into this renewable energy much ahead of time. Before anyone in GCC could manufacture these transformers, we manufacture these transformers and place ourselves in a better position. That's how we were able to supply this Sudair project, which was inverter duty skid solution, which has no one in Saudi Arabia was able to do it, or no one in GCC was able to do it. So we developed ourselves that way. So we are working with Chinese consortiums also to take our product for localization content, like in Saudi and Saudi, where localization content is being enforced. There are Chinese manufacturers coming in with the investment with local development also. We want a similar sort of thing happening in Oman, but right now it is not there.
Okay, got it. Thank you very much. Thank you for answering all the questions.
Thanks.
And wish you all the best.
Gentlemen, I think we are nearing to the end of our time. If any other question is there, we can take one more question if it is there. If not, then I would thank all of you for joining this meeting, and see you in our annual meet of annual results, inshallah. Thanks all.
Thank you very much. Thanks a lot. Sure, got it.